Okay, I want to welcome everybody to our first weekly Market Makers Mastermind call. We will be doing this every week, Wednesday, 1 o'clock Eastern. So if you're a licensed real estate agent, you're trying to find ways to make more money and thrive in a different market than it was a few years ago, and or you're an investor as well, and you're trying to get more deals, then this is a community that you'll be able to come back to every single week and hear us talk about how everybody's serving buyers and sellers out there right now. So being that this is our first one, we're going to open up to kind of set a tone for, first of all, to answer questions about who we are, why we're doing this, and what the goal of growing this community is going to be long term. So we're going to cover that today. In future weekly phone calls, we're not going to spend as much time on the front end, this preamble. But today, since it's our inaugural weekly event, then we want to be sure that everybody's perfectly clear about who we are and why we're doing this. Okay, so without further delay, let's get right into it. So ultimately, this weekly group call is going to be about you, what you're doing out there in the field, how you're serving clients, what are some of the innovative ways that you are working with buyers and sellers. And then also we get down to pretty granular stuff too. So it's all about sharing what you're saying, scripts, tools, best practices. That's what we're here for. And you're not going to hear, unlike a lot of calls that are hosted by different people for different things, you're not going to hear us just sit up here and talk the whole time. So these are going to be more engaging and more valuable the more you are contributing to the conversation. So this is, again, about you. It's not about us. Although we're here to just facilitate this, keep things moving on, keep it sticky, and to give you our perspectives when you're asking for them. Okay, so later in this phone call, the bulk of the phone call is going to be about addressing what you're dealing with in the market right now. What are the problems that you're having? What are some of the unique situations you're kind of coming into that you could use a little bit of assistance for? And then we'll do more of a Q&A format for the bulk of this phone call. That's what you're going to hear mostly from this phone call. Okay, so it's really about you and what you're dealing with right now. We're going to target 1 hour duration. If some of you have to log off and there are some people that we haven't been able to address or get to, then we will extend it longer, but that's completely optional to you. These will be recorded. We're going to archive every one of these phone calls. Eventually, they're going to be in a podcast format. But right now, we'll just put them on video hosting platform and then send you the link right afterwards so that you can access it. In the future, we'll have a place where these will be parked and you can come back to them. If you can't make the whole session, or if you miss the event, you got to come back to it later, or if just Wednesdays at 1 p.m. just don't work for you. Okay. So the way that you can interact with us when we get going here is you'll see a little icon on your control panel on the bottom of the web conference. You'll see that little hand icon right here. If you'd like to ask a question or you want us to call on you for whatever, then go ahead and just raise your hand, and that'll prompt us to open up the conversation, unmute you. And we have everybody muted just as a courtesy to everybody else. So we're not hearing a lot of the background noises, okay? So we'll keep it that way, but just raise your hand if you have something to say, and we'll be glad to call on you. And then when we finish just about the first 10, 15 minutes of just these opening slides here, we're going to go into that full Q&A session. So again, the more you participate, the more we all get out of this format. So today, what you can expect is we're going to cover the who, what, and the why behind the Market Makers Mastermind. You're going to hear a little bit about our backgrounds, myself, my partner R.H. Richards, and my partner Chad Corbett. How many of you, by the way, show of hands, are here because of either me, John Chin, or Chad Corbett? Because I know a lot of you have touched us from our education backgrounds and our training backgrounds, either with Chad's background on the probate side, my background on the creative finance side. RH, he hasn't been as much in front of the room on the coaching and training. He's been in the trenches more the doing. But if you're here for either me or Chad, I'd love to see how you guys heard about us. And
I'm gonna sign off. I'm just gonna hang up real quick.
Yeah, what prompted you guys to join us? We got chopped liver in the corner.
Yeah.
So yeah, what prompted you to join us for this phone call, by the way? What made you curious about coming on to this so we can meet your expectations? Then we're going to go into what the state of the economy is, how we're seeing the market right now. And then we're going to talk about the unique market maker approach, which if any of you know the three of us, you know that we take a little bit of a different approach to helping clients, working with sellers, and doing deals in the market. So I'm curious, though, what prompted you to join this phone call? Go ahead and share that in the chat. And if there's anything that you expect from this phone call or you'd like to see on this call, then go ahead and put that in the chat window so we can, we'll look at those and make sure that we can address everything that you're asking for. And then the last thing is, for those of you that hang out to the end, and by the way, this is not a sales call. You will never hear us pitch anything on the call. We are founders of a short sale processing company. You'll hear us mention that from time to time, focusing on Florida distressed properties right now and properties that are upside down here, because that's where this market is and that's what this market is asking for. But we're not here to sell you anything. This is really just a value add. We love to share, the three of us, and anything that we can provide for, and hopefully you guys kind of share the same spirit, right? And that's reciprocal, that everybody's here just to share. And then at the end, we will share a gift with you about how to, if you're not already serving in a consultative capacity to people in distress scenarios with sellers, this is the key. We're going to give you a tool that is the key to getting sellers to act and for you to be able to diagnose their problem correctly so you can provide a meaningful and a relevant solution for them. Okay, we're going to give that away at the very end. So why the Market Makers Mastermind? This is a product of us just getting called by audiences like you to help you with different creative finance solutions, working with different niches within the industry. As all of you already know, I know I'm preaching to the choir, the industry is evolving right now. We're starting to see institutional clients and hedge funds getting into our space. You saw how disruptive that can be with, like, for example, Zillow. You see iBuyers coming into our space. You see Divvy doing lease options. You see a lot of different solution providers coming into the residential space, and it's exponentially getting faster, a lot of those innovations and those disruptions. So unless we want to get T-boned, then being in front of a lot of those changes and that evolution, being part of evolution, is how we get in front of a lot of the commissions and the deals that are going to be in front of us, as opposed to letting these third parties outside of our space come in and hijack our clients and these deals. This is how we maintain control of all of that, is by providing the solutions ourselves. And that's what we're here to do. That's the purpose for all of this. So it's for us to keep up with this evolving industry. Who is a market maker, by the way? That's all of you on this phone call. A market maker is either an investor or a licensed agent, or a licensed agent who also invests in residential properties, who takes a consultative approach to solving problems for buyers and sellers. And if you think about how most people operate in our business, whether you're an investor or a licensed agent, they're typically salespeople. And here's what a salesperson is. A salesperson is somebody who has one solution and they're selling a seller on their one solution. If you're an agent, a lot of times that one club is a listing. I can put a sign in your yard. Here's some comps. I can put it on the MLS and we can sell your property and net the most money possible. But as everybody on this phone call knows, that's not a traditional listing. It's not a of sellers. And on the other side of that spectrum, you have investors who can bring a cash offer to the table. So they make an offer and they need to buy that property at 60, 70 cents on the dollar after rehab. And if that doesn't work for the seller, then there's probably 5 or 6 other ways we could have helped them that we're completely disregarding, and we're doing a disservice to ourselves, our families, and to the seller in that scenario. So what we do as market makers is we bring multiple solutions to the table. For example, we have a gentleman out in San Diego who is also a licensed agent. His wife's the licensed agent. He wears the investor hat, and he will provide the option of doing a fix and list, where they'll fix the property up. If it's a light rehab, doesn't require a lot of licensing or permits, doesn't require any permits. He'll do the cosmetic rehab. He'll put the money into the property, and then they'll help the seller sell the property at a higher commission rate after costs. He can do a cash offer. He can do an income offer or creative financing. He can do also a traditional listing as well. So in that sense, he brings 4 different clubs to every single seller. As you'll learn over time, you're going to hear about different people in our community that are bringing different clubs and solutions to sellers and buyers. Right now, a lot of what we're doing, because of the mortgage defaults, we're focusing on distressed properties, specifically properties that are upside down. We're also doing a lot of creative finance transactions in the brokerage community to help buyers and sellers come together with smaller monthly payments and lower interest rates to help deals happen that wouldn't otherwise happen because buyers don't want to pay today's prevailing rates or they've been priced out of the market. So these are some examples, and we'll get a lot more granular with these solutions and how we execute these, and we'll share different case studies about them. And that's a two-way street. So we want to hear from you as much as the anecdotal case studies that we share as well. So a little bit about how we think and who we are as people. And this is our whole community. So number one is, I think that if you know RH or Chad or myself, we're all about lifestyle and freedom first, and being able to choose what we do, when we do it, and whom we do it with, right? So that's priority number one within our community. That's why we do what we do. Never lose sight of why we're working in the first place. We take a bigger picture approach to everything that we do. So it's, as opposed to being just very myopic and focused on some of the signals inside of the real estate business and just keeping an eye on what's happening in real estate from the association publications and a lot of industry publications and the content that we see in our little real estate echo chambers, we try to zoom out and take a bigger picture view so that we can anticipate better what's on the horizon. So we're forward thinking. We want to know where the puck is going. We don't necessarily care where the puck is right now, so that we can be more proactive in our approach to how the industry is evolving and how we kind of fit in, how we're solving problems for sellers. We don't like to compete. So if you ever heard the story, if you've been around some of my trainings, you know about the story I talk about with Gary Halbert and the hamburger stands, right? Gary Halbert, a marketing genius, asked his audience, if we were going to compete selling hamburgers, what are some advantages you would want to outsell me in hamburgers? And you hear answers from the audience like, oh, I want better ingredients. I want cheaper prices. I want better customer service, better marketing, better location. Gary says, I'll give you all those advantages, and I just want one advantage, and I will outsell you every day of the week. And that's a starving crowd. So in our space, we're always looking for where those starving crowds are, so we don't have to compete with everybody, because when you compete in an oversaturated market of investors and of licensed agents, then you have to work twice as hard. You got to have a lot more financial runway, more marketing dollars, more time prospecting, and to make the same amount of money, as opposed to just carving yourself out a little niche. So that's a philosophy that we always hold, and we are living that today with the short sale processing that we're doing as an example, the creative financing we're doing as an example. We have no competition. And ideally, when you find where your little niche is, the goal is for you to find a little rhythm and a groove in your specific market with your own style, with your own pocket of solutions that render the competition completely irrelevant. That's the goal. So when we get there in this community, by sharing. So you'll find that me, RH, and Chad, we're abundant mindsets. So we share everything almost to a fault. So one of the tools that we're going to share today is one of the most powerful tools that we use when we're diagnosing problems for sellers, right? It's our seller urgency questionnaire with the tutorial that comes with that. We'll share that at the end, but or give you the link to get that for yourself, but it's all free. It's just all value that we want to provide. And then, of course, we're always keeping the seller in mind. So whatever solution that we provide, we want to do what's best for the seller. That's not just rhetoric or something that sounds cliche. It has to be good for the seller, right? Or else we just don't do it. We just walk from the deal. So what is the Market Maker Mastermind weekly call? It's essentially just a conversation that we're going to have with each other every single week, where we can come together, like-minded people that want to serve sellers, that are forward thinking, that are zooming out and kind of seeing what's happening from a global economic perspective, what's happening with monetary policy. You're going to hear these conversations every single week. So ultimately, we want to just evolve ourselves as licensed professionals, as an investors, by just coming together and having these conversations. So a little bit about our backgrounds, if you don't know myself or Chad or RH, we all have, we've all gone very deep in our respective disciplines. And collectively, though, I think as it relates to having credibility, facilitating a conversation like this every single week, is we all have development background. We all come from education and coaching. We all have worked to raise money for various projects and or privately funded deals. We've all personally transacted thousands of transactions, and a lot of them are not traditional transactions. So they're lease options, they're creative finance transactions that involve seller being the lender. They're transactions that involve short sales, whether we bought the short sales, we facilitated the processing for a short sale, the negotiations for that. But we've touched pretty much everything that you can see in the market. And collectively, haven't even done the number yet, but our years in real estate, I think between the three of us, where are you, Chad? I know that I'm at 30 years.
I'm at I'm 20 this year.
Yeah, RH. You're muted.
I'm at 20 this year.
Okay, so that's 70 years collective real estate experience, both with investor hats and with as licensed real estate professionals as well. And then, of course, right now, we are processing short sales through the company Loan Mitigation Services. Loan Mitigation Services, if you ever encounter, by the way, a property that's our shameless plug here, if you ever encounter a property that's upside down, where the seller has to bring cash to closing that they don't have, then that's a short sale, and we can help you get that property closed. So with that, guys, let me kind of give you a broader perspective of how we're seeing the market right now, and then we're going to jump right into the conversations, okay, and see what you guys are dealing with right now. So first of all, we all know, and I know I'm preaching to the choir here, especially you licensed agents out there that feel like things are just so much harder. It's just so much harder to get a deal closed. It's because real estate transactions at a 40-year all-time low. They haven't even been this low during the COVID timeframe. They weren't this low during the financial crisis of 2008. So in recent times, where most of us have been active in the business, either as investors or licensees, we haven't seen the market this slow. Buyers just not coming off the fence. Sellers not wanting to let go of their super low interest rates. It's not happening. Meanwhile, inventory is growing. So when inventory grows and demand isn't there, then you have properties price reductions or quote price improvements, right? We're seeing that worse in some markets than other markets. But I'm curious, in your market, by the way, if you're a licensed real estate professional, just put in the chat really quickly where your market is right now. We're going to have a quadrant we're going to show here in a second about the four different phases of a real estate market cycle. Kind of curious to see where you are right now. But a lot of people blame interest rates, mortgage rates. If you go back 50 years, though, 20 of those 50 years, interest rates were over 8% for mortgages. 12 of those years in a row, they were over 10%. So historically speaking, rates today at 6.5%, give or take, are even lower than the 50-year historic average. It's not the real estate, the mortgage rates that are causing the slowdown right now. What's causing the slowdown right now more than anything else, and this affordability crisis, is you have home values and asset values that have gone up like a hockey stick. Meanwhile, our incomes have remained relatively flat. So if you see on this chart right here, the home prices in 1985, and this was also true during the Great Depression. If you can imagine, during the Great Depression, home values were about the same price, relatively speaking, compared to incomes that they were in 1985. During the Great Depression, you could buy a house for 3 times what your average annual salary was. 1985, the home values on average were about 3.5 times what your annual income was. If you fast forward to the 2008 financial crisis, they were about 4 times the average income. Then you see all the money printing and the unsustainable monetary policy we've had since 2009. And all of a sudden, the devaluation of our dollar jacks all asset values up, from Rolexes to fine art to properties to used cars to new cars. Everything's more expensive now, groceries, because our incomes have stayed flat and the dollars have become weaker. So in nominal terms, it takes a lot more of those dollars to buy the same stuff. And that's what's causing the affordability crisis. So now property values are 5 to 6 times the average annual income. And that's what's causing all the financial pain. It's not because of rates. It's because our money supply has been expanded so much from all the printing that we do that now those dollars, those units of measure become less valuable. They become worth less. So it takes more of those units to buy the same stuff, which isn't a problem if our income would go up at the same rate, but our incomes have stayed flat. So when you have that combination, you create a debt crisis. And now we have a debt bubble, a global debt bubble, national debt. You have corporate debt, commercial debt, corporate debt. You have bankruptcies going through the roof right now, car repos going through the roof. Tow truck companies can't keep up with the car repos. So you have a lot of debt defaults. That also means mortgage defaults. And that's why we're in the space that we're playing in right now. And in some areas of the country, that's a bigger crisis than in other areas that may not even feel it. Other areas are, it's too early and they haven't felt it yet, right? But I think the consensus is right now that we're in the first or second inning of this 9-inning correction. And that's at least what we're feeling right now. So when you look at the 18-year real estate cycles, this is a good summary of what we're talking about here. There are 4 phases of a real estate cycle, give or take a few months. For the past 100 years, this has been the pattern. You have some of those years that are recovery periods, and recovery periods happen slow. Expansion periods happen slow. So when things get better, it happens slow and incremental. When things get bad or there's a correction, it happens a lot faster, right? So you have the recovery period where things start to go up from the bottom. Expansion, hyper supply, that's when we've overbuilt and there's too much supply. Now prices have to correct. And then we get into a recession and then the cycle starts over again right now. Which cycle, quickly, do you think that you guys are in right now in your specific market? Name your market and name your cycle: recovery, expansion, hypersupply, or recession. Just so we can see where you're at. This is the participation part of the hour, guys. What cycle are you in and what market are you in? Or what part of the cycle? Alfredo, what market are you in? Oh, LA, they're feeling hypersupply as well. Hypersupply, Houston 2-3. Yeah, we've heard some horror stories out of Texas. Yosemite 3-4. Yep. Citrus. Okay.
Definitely mostly Austin was getting all the media, but now you're starting to see Houston, you know.
Yeah, so I think most of us are in phase 3 or 4. Yep, West Volusia. All right, appreciate that, guys. So here's the good news, so that you're not all depressed over the next 60 minutes. The good news is, if you're positioned well, it's like Robert Kiyosaki says, a lot of businesses that were formed during the recession did extremely well, because if you're positioned right during the correction period, then it happens so much faster during the expansion period. So if you're positioned right and you have solutions that are relevant and people know about them during the backside of the contraction period, which is slow, then when this roller coaster hits the backside of that and goes much faster, then we're going to be in front of this wealth transfer. Make no mistake, we are in front of the biggest wealth transfer we'll see probably as adults, and that we have seen in the United States. And I could say globally. And if we're positioned right, which is the purpose of this phone call, is to position all of us in a way where we're on the receiving end of that wealth transfer. That's ultimately what this is all about in the context of residential real estate. So with that said, we believe that the key to being positioned right is to be more versatile. So I know some of you heard me say before that if you heard the expression, if you're a hammer, everything looks like a nail, that essentially means that if you're a licensed agent and your solution is a listing, then you're going to sell listings all day. If you're an investor who only pays cash for properties, then you're looking for properties at a discount. If you're a sub-2 investor and all you're doing is looking for loan takeovers, then everything is going to be an offer with a loan takeover and a check for the seller's equity. And if there's any solution that seller needs outside of that, then you're not getting the deal done, right? And so ultimately, if we are more versatile, we have more clubs in our bag, more solutions that we can execute and help sellers with, then we're going to be positioned for what we believe is on the other side of this, on the receiving end of this wealth transfer, on the other side of the correction. And that will then put us in, ideally, in a place that we're monopolizing a certain space as opposed to trying to fish out of the same, with 100 other people on the same lake. What we're trying to do is find that little pond where nobody's fishing in it, and we own that space. That's the ultimate goal here. So with that, guys, I'm going to hand the microphone over to Chad, and we're going to talk about what you guys are dealing with out there and how you're addressing the correction right now.
Yeah. Hey guys, for those of you, I see a lot of familiar names on here. I'm Chad Corbett. I am in New Smyrna Beach for the winter, and I think it's interesting reading the comments, just watching everybody's market reports roll in. There's still a lot of residual good news. In 2007, I actually would work my way to the top of a sales team and a ski resort. I sold ski front whole ownership. I didn't know enough about economics to understand it at the time, but I went from 25 listings to 150 listings, and that prompted me to move my entire career. I moved to the Smoky Mountains, and sure enough, it happened in 07, and the public found out about it in 08, right? We transitioned from hypersupply into recession and the 4-stage cycle, I believe, somewhere around summer of 07. And we waited till Bear Stearns and Lehman Brothers, fell out when I lived in Washington in 08 is when the world found out. So we might sound like Chicken Littles from time to time because we're looking at leading macroeconomic indicators and trying to put you guys in front of the trend. And that's something I've pretty much built my career. And I've had license in 4 different states and built my career coming out of that last cycle. So we've, part of I've really cut my teeth and one of the hardest times when the market was trying to find a bottom and was frozen. And now we're in that kind of at the top where we're frozen. So it's interesting to see, but the consensus among everybody on this call, we seem to agree that your market, most of our markets are in that stage 3 of hypersupply, or some opinions are that you've already entered into the recession. So this is about starting early. It's hope for the best, but prepare for the worst. Sellers are going to hear good news from the media. They're going to hear good news from NAR. They're going to be looking backwards because we use comparative market analysis and residential real estate. So it takes some time. And the good news about that is you have time to prepare yourself, get to know your peers in this group, consume the education that we're going to put out there for you guys, and really network and learn. And I see a lot of familiar names here. You guys have heard me in the probate space. I've taught creative financing, private lending, short sales, just all these different strategies. But that was in one little blue ocean that I created. So anyways, thanks you guys. Thanks to everyone for chiming in and telling us how your market is. And we've got a lot of hands up, I see. I guess we'll start at the top. Well, we had a few up. So Sergio.
Just unmute yourself, guys, and then feel free to
you can Sergio Garcia, you can unmute yourself.
You want to go on to Kenny?
Yeah, so Kenny Gonzalez, you can unmute yourself.
Maybe they're testing their hands up.
I'm sorry. I'm on a call right now. I got to take it.
Okay.
I do apologize.
We'll come back to you, Kenny.
No worries. Sergio, are you still there?
Hey guys, hey, this is Sergio. Hey, my apologies, man. I guess I hit the hand signal by accident. I've been listening here. My apologies.
Yeah,
it's all good.
Hey, but good information here so far, man. I'm impressed, guys. Very good info here. Appreciate it.
Well, hey, Sergio, just while you're up, I see in the chat your West Volusia, which is Deltona, DeLand, DeBerry, Orange City. Just give us some high level thoughts, if you will, just because I've done quite a few deals in West Volusia. I love that area, and I'm just curious to see kind of what your pulse is right now.
I'll tell you what, man. Main Street Realty is my brokerage. I own the brokerage, and it's more of a family-owned brokerage. And I'm not really a producing broker. I normally let my agent do all the work. But I can tell you, my two top producing agents are actually my daughters here. And I can tell you, between both of them, they got like 20 listings. I'm going to tell you right now, the buyers, there's buyers out there. But what's happening, they're just kicking tires right now, looking around. They're not really committing to any of the house. You know, it's a difficult situation here where you have a lot of sellers who wanted to sell their homes, but the buyers are not, they're out there, but they're not pulling the trigger to buy these houses.
So is the disconnect the pricing? Like the expectations between sellers and buyers?
Yes, I think there's a disconnect with the sellers. You know, I remember, I don't remember, but my daughter was telling me the other day, she went to a listing presentation and the seller wanted to list the house $50,000 more than my daughter recommended. And my daughter just plain out told the sellers, I'll tell you what, if you want to list it at this price, you're going to pay for the pictures. And we'll, instead of 6 months listing, we're going to list for a year because this house is going to sit at that price.
Yeah, that's right.
And one thing also is, if you list right now, because of the economy, the way things are going, if you list your house at a wrong price, it's a death knell. It's going to kill you. You won't be able to sell the house.
Yeah, I'll take that one step further. If you list your house at retail, you with today's the small amount of buyers out there, you'll chase the market down. The strategy is, because I've sat on flips before to where I learned the hard way, but I chased the market down looking for top dollar, had to keep reducing, chasing it down instead of just selling it short of the market. Let's say retail's 200,000, get out there and just sell it for 180, 185 and just get a payday and get out of Dodge, you know?
Right.
And a lot of people, they'll chase that 200 all the way down to 150 and they'll lose their shirt and their family savings in doing so.
Sergio, the other thing, something I wanted to add, and John can really speak to this because he's actively working several of these deals right now. When we're in this kind of frozen top, just waiting for sellers to meet the market with pricing, one way we can move the market and make transactions happen. And in your example, your daughter could have said, okay, well, we can list it at that price, but at that price, we're going to have to offer terms to the marketplace. And what I mean by that is you need to be willing to step up and help with financing. And sometimes that could mean a seller rate buy down, but more commonly it could be a creative financing transaction where the seller holds a second. So it's a balance. So we have price and terms, and we have to find a way to balance those out if you're trying to sell at a premium. So you can still take the listing, market as seller financing available. Then you're going to appeal to a whole new set of buyers. And you'll get a lot of attention by doing that. So it's something you might try, especially with stubborn sellers. If they have equity, that's what's very different now than what we saw in 07, 08, is there's a lot more equity for now. So while we have those high equity levels, educate your sellers on that. Listen, if we're not meeting the market, there's other ways to do that other than just adjusting the price.
Yeah.
No, I agree. We've done the rate buy downs as well. We've done that before.
Yeah.
Hey, Sergio, I'm curious. And by the way, if you guys are listening, can you put in the chat what your buyers, if you work with buyers or you're in traditional residential real estate, what are the buyers saying to you as far as their reasoning for holding off right now, not pulling the trigger, not talking to a loan officer, not taking those steps? What is their reasoning? I'm curious. You hear some people thinking because, I think rates are going to drop and I want to wait for that. Or, I think prices are dropping. I want to wait for better pricing. I'm kind of curious to see what you guys are hearing out there. But Sergio, when we talk about creative financing, there's a misconception that sellers can only finance their properties if they own them free and clear. And probably 8 out of the 10 creative finance transactions that we're doing right now are with property owners that have underlying loans in place right now. They just leave their loans in place and we do what's called a loan wrap. They still offer a loan to a buyer. So if you happen to have a a listing and they've never been presented, sellers, a lot of them have never been presented the benefits of owner financing. They usually have these two misconceptions that are wrong. One, I can't finance my property because I owe money on it right now to the bank. And there's another misconception that, oh, a default's going to be really painful. And what does that look like for me? Oh, and then the third one is, how long do I have to wait for my money? Because they think in their heads, 15-year mortgage, 30-year mortgage, I got to wait that long for my equity. So when they understand that there's a bulletproof way to protect their interests in case of a default, they're actually going to fare better. And you'd almost hope and pray that there was a default because they get to keep the full down payment. We structure this in a way in Florida where they don't have to lien the property to secure their loan. So they don't have to contend with the foreclosure process if there's a default. And then third is they can do the loan for as long as they want to do it. They can carry it for 3 years, 5 years, 10 years, and then put a balloon payment on it. So there isn't the objections a lot of sellers have are in their imaginations. And agents, we should be educating them about dispelling those myths and knowing how to do that. On the positive side, a lot of sellers don't know the benefits, right? So there's some sellers that are thinking that I can't sell this property with financing in place because I need my down payment for my next purchase, or I need some of that cash or equity for my next purchase. Well, if you can get a big enough down payment on the sale of your property to cover your down payment on your next purchase and still qualify for that financing, that doesn't prevent you from financing your property. Do you guys know how many properties on active listings? And by the way, we were at this about 14 months ago. I want to say February of last year, we were at 49,000 active listings. 49,000 active listings. Today, we're at 76,000 active listings. Back then, so 14 months ago, a little more than a year ago, we were at 16,000 closings a month. This is stellar wide, our stellar MLS. Today, we're at about 10,000 closings per month. That's come up now to about 12,000 closings per month, right? We'll have a spike at the end of the last week of the month always, right? But if you have less demand and you have a lot more growing inventory, so 14 months ago, we were at 2.5 months of supply. Today, by those metrics, we're at about 7.2 months of supply. So if we're increasing supply and the buyers aren't showing up, why is it that still only 1% of all active listings, when the number one objection right now that's eroding people's buying power that we have control of is the interest rates? Why are only 1% of all active listings offering owner financing at a rate that sellers can't pay to buy down like builders can? And that's why we see so many builder inventory sales, new construction sales, as opposed to resales, especially, and you guys have a listing that is a newer home and there's a builder across the street or even in the same subdivision that's selling that same model with concessions and buy downs. There's no way that that property is going to sell for the same price that new construction home, that model home. It's just not happening. So we're seeing in the peripheral markets around the city center where you have subdivisions and new construction homes and production homes being built, those sellers in those areas can't sell their properties. And so they're sitting longer and they have to sell them at pretty significant discounts. They have to leave a lot of equity on the table. So what happens if you can tell a seller, look, I can make your property as attractive as these other listings by offering these buyers a better rate than the builders are even offering these buyers with their buy downs. And if they have a low interest loan or some equity, we're able to structure that financing for their buyers with a payment that saves them $400, $500, $600, in one case, $1,300 a month compared to what the prevailing rates are at the banks. And now the property is way more compelling and more competitive with those new construction homes, right? And the new build inventory. So if sellers were property educated and they knew that, number one, they can net more money in total and command a higher price for their home by being flexible on terms, like Chad was saying. Number two, they can create a truly passive income with their equity in the low interest loan. That spread that they can make a truly passive income where the maintenance, the taxes, the insurance is on the buyer's shoulders. It's not like landlord income, it's lender income. And then number three, they can save a ton of money on their tax bill if they have a huge capital gain hit the year of that sale. So if you're ever talking to your investors who have rental properties, that's why so many investors who are divesting. If you guys know older investors who have a rental portfolio, they're selling all their properties now. A lot of them, more than anything else, they want to do owner financing because they don't realize the whole gain from the sale the year that they sell their property, and the IRS isn't going to come knocking saying, hey, you owe me 40 grand because you put in your pocket the profit from the gain you have on the sale this year. If they owner finance their property, they get to tell the IRS, look, yeah, I sold it for this price. And that's not what I put in my pocket though. I only put in my pocket this part of the down payment, or this portion of the sale price, which was my down payment. So I get to defer now the hit I'm going to have on that huge gain that I have on the property that I've owned for 20 years or 15 years over the term of the loan. So there's a lot of different reasons that if we're educated on how to do that as listing agents, I think that this is my opinion. If sellers knew the benefits and somebody addressed the misconceptions they have about the objections they have about owner financing, every seller and every listing presentation talked about that with sellers, you'd have at least 20-30% of all active listings with owner financing today, minimum.
And I think even more on the high side of the market, where you have more equity and a more sophisticated seller that could understand it and could benefit in all the ways you said, including taxation. It's what we see, like in the we can segment these broad market statistics that we've reported. If you look specifically at the higher, like on the lower end, we see FHA defaults at 11.3%. So that shows a lot of stress in the low end of the market, and that's nationwide. And the higher end, you have lower default rates, but there's a lot more equity that they're clinging to, and the volumes have just plummeted. So if you have, if you're in a higher end market, this can be a really, really good tool. And, the same thing for buyers. You've got, business owners, people, there are a lot of buyers for higher end properties on terms. So especially if you're looking at, the top of the market, it could be a really effective tool.
Hey, I want to throw out a small bit of caution just because we're in springtime and a lot of markets do see a little bump in sales during the springtime. So if you are in a market where maybe you are saying that your market's going from 2 to 3 or sitting in 2, it could be a false positive. The key here is to see if whatever trajectory you're noticing at the current moment through spring holds on till the summer. And if it's not, then it's just kind of a spring bump. So just be leery of that.
So maybe on the next call, we'll provide how to structure owner financing. Maybe we can talk about that if you guys want to hear that. How do you structure owner financing and qualify a seller to be able to have that presentation for them? And that's something that we can help you guys with, by the way, separately. But if you don't know, if all you know how to do is say, hey, these are the benefits of owner financing, maybe you should consider them so we can net you more money in total. And it won't affect you buying your next property, by the way. And we have default protections in place. And then you can dispel some of those concerns. If they express interest in doing that, you just have to engage us and we can walk you and the seller through the process of doing that. And then you click the owner finance button on the MLS as one of the available finance terms, and then watch what happens to your showings. By the way, here's what's going to happen. You're also going to get, first of all, you'll be in the 1% club. Of the 76,000 active listings I mentioned before on our MLS, less than 700 have owner financing available. So now that property's in the 1% club. It's truly differentiated from everything else. And the number one feature that people are going to be attracted to, most buyers, is going to be what they see in that first line on Zillow in the description in all capital letters: easy owner financing available, 4.9% rate with X% down, right? Whatever that is that the seller agrees to.
I was just say it's such a huge win-win for buyers and sellers. I mean, the seller get to kind of retain as much equity as possible. The buyer doesn't have to apply, get approved, pay points, all the inspections, right? They lock in at a good rate. They don't have to bring all that cash, if it is a cash deal, to the table. If it is an investment property, their cash on cash return goes through the roof. I mean, in this market in particular, where there's such a disconnect between sellers and buyers, I think that is the number one vehicle to find synergy once again.
Yeah, so we'll cover that based on the feedback I'm seeing right here. We'll cover that on the next phone call, and our giveaway on the next phone call is going to be the owner finance template that we use to quickly structure what the financing would look like for that seller. So you at least have a starting framework to put on the MLS to offer that property. And if you happen to be an investor or a buyer, it's a tool that you'll use to structure the financing that you would want to offer a potential seller. I'm literally doing this for one client right now, is making offers with her down payment on tired listings to get owner financing in place with sellers and listing agents who don't already have it marketed with owner financing. And then also for my son, who's in Hampton, Virginia, he's in the Air Force, and him and his new wife are looking for a property. They have some down payment money. So we're out there right now just calling listing agents, and I'm just showing him how to have that initial conversation with the listing agent on a property that the listing agent is fearing they're going to lose an expired listing. They're going to have an expired listing and spend all this money on professional photos, all this time doing these open houses and chasing signs out in the median before and after the open house, and driving across town to this listing. And they're going to basically do all that work for nothing. So we're finding those listings and offering owner finance terms to help him get a monthly payment that's about $400 or $500 less than what he get from the bank today, right? And not have to deal with credentials, underwriting, all that paperwork. It's especially attractive for buyers, by the way. If you guys work with foreign investors or buyers that can't get U.S. financing, it's perfect for those buyers. It's perfect for people like us on this phone call who are 1099, who get write-offs on our taxes, and it kills us when we talk to the loan officer with conventional financing. And it's perfect for, of course, buyers who aren't mortgage ready because they got to clear up some debt or a medical bill or whatever. And then maybe in 2 years, they can be mortgage ready, and the seller would only have to finance them for a 2 to 3 year balloon period, right? So we'll talk about that on next week's calls. We'll do a quick intro on how to structure owner financing and how to talk to sellers about it, whether you're an investor or you're a listing agent. And then we'll share the owner finance template so that you can structure what the owner financing looks like, whether they own it free and clear, or if they own the if they have a existing loan on the property that they'll leave in place for the finance period. But let me make this clear too. If you're a listing agent and you've had properties on the market, you've gotten subject to offers. I want to be perfectly clear about this. We do not do subject to transactions because with our brokerage hats on, we do not feel that they're the best way to structure a loan takeover or to hand title off to a buyer and then leave a loan in place. If you're not familiar with what a subject to transaction is, it's when someone buys a property, gets title to the property, subject to the seller's loan staying in place on their credit and on their name. And then the buyer makes the payments for them. It's not a loan assumption. It's me taking over the payment on your car and getting title to your car. And then if I miss the payments on your car, on that loan that's on your credit, it's going to affect your credit, not mine, right? So we don't do subject to transactions. There's a much safer way to structure financing where the seller's loan stays in place and the buyer can take advantage of that rate. So we'll cover that a little bit more next week, kind of an intro course into that, okay? We're going to, unless anybody, we had a couple hands that were up. Why don't we address those hands that are up right now? Kenny, are you ready to talk? Okay, let's move on to Alfredo. Alfredo, is your hand up by accident or was that intentional?
It was intentional at the time. But I mean, I do have, I guess, some questions. I was just going to say a lot of what everyone, Kenny, you, Chad, everything you guys said was in line with everything that's going on with sellers, market, and people. I mean, as far as owners, they want to price their homes at a high price. I think because they look at the prices that the houses around them have sold, and they show as previously sold at a certain price, but these prices were at a time where rates were better. So they want to guide themselves with those prices, not taking into account, the current market. And you try to explain, and they just feel in the heart of hearts that, they could probably get the amount that they want to set the price at.
Until
you know,
6 months goes by.
R-
and
exactly.
you're fall off a cliff. Yeah.
Exactly. And so, also one of the things, because I go in, I try to do investing in foreclosures, both tax deed and bank owned. And I mean, you go in there and you try to bid, and you have to set a price that makes sense to bid on, is you have, you know, the county fees and, you know, all this stuff that you have to add in after the sale, plus the time it's going to take to uh you know, clear the title and all this stuff with the attorney afterwards. um and people are buying these houses that are in foreclosure, at least the tax deeds for sure, at market value or above. And I'm like, I don't understand, like how it is that people are buying uh these houses above market value. I mean,
It's the same
Yeah.
psychology that you see in equities. I mean, retail investors are piling into stocks with PE ratios north of 150. Like, it's garbage. I mean, it's overvalued, obviously, but that's where we're at in this from a macroeconomic standpoint, and the greater credit bubble. It just takes time until someone has to sell to set the standard, you know, to set the new pricing. And that's what I meant earlier about, you know, we're early to this conversation. So it's easy for critics to say, oh, you're wrong. This is just, as soon as rates go down, everything's going to break loose. But I mean, I would point to sellers, point them to mortgage applications, and like how we're at historic lows. The demand is saying no. So at this point, Mr. Seller, you're catching a falling knife. Do you want to be the first to tip that on the downward price scale? Do you want to sell it up here, or do you want to wait and stubbornly end up selling when you have even more competition in the marketplace? And, you know, I would encourage you to educate yourself on consumer finance. Look at revolving debt, outstanding revolving debt, student loan debt, and keep in mind that those factors don't even include, you guys have seen Klarna on everything, right? Like, if you're shopping for groceries or clothes, there's an option to finance everything. That debt's not even being rolled into the consumer finance debt reporting because it's private equity driven. So it's not being reported to credit agencies. So it's helping them understand the pressure on the buy side. And in your instance, like if you're talking about foreclosure auctions or tax liens or deeds, it's you know, not relevant. But eventually it'll catch up there too. But really, I think in this time, that's what I found in my career when so the biggest problem is appropriately priced inventory. And we can say that incomes are too low or inflation's too high, but at the core of it, it's we don't have appropriately priced inventory. So if we can educate our sellers on how to appropriately price, then we can actually, you know, create the demand that's on the sidelines right now. John, we're at 2:00 and we have Fed and Ramey still in the queue. Alfredo, do you have anything else to add?
No, I just I'm just I'm enjoying the information you guys are giving out. I appreciate the time you're taking to go through it.
Yep. Appreciate you joining us. And if you're joining us, be sure to share this with your counterparts, right? Be sure to share it with your counterparts. We want to grow this community so that we're just learning more from people, especially if we're in different markets, so we can kind of see a diversity of what people are dealing with out there across the country, not just where a lot of us are located right now in Central Florida. But that said, hey, to honor our time, we're going to come back to the couple hands that are up. For the people that have to leave, though, let me get to the giveaway here. Every week we're going to try to give something away, right? If we have some tool or resource or something that we can provide. This right here is the seller urgency questionnaire. If you go to MMMweekly.com/questionnaire, you can put that in your browser right now. That's going to take you to the seller urgency questionnaire. There's a famous saying, prognosis without diagnosis is malpractice. You can't prescribe as a doctor medicine for a client unless you've done a proper diagnosis. And in the same way, a market maker, if we're trying to solve a problem for the seller, the way that we are able to solve that problem for the seller in a meaningful way, in a relevant way, is by doing a proper diagnostic. So the seller urgency questionnaire is a tool that we've used as licensed agents and as investors when we're talking to sellers to extract. It does three things for us. Number one, it extracts all the information that we need from a seller so that we can then put together, okay, based on the equity, based on their timing, based on the condition of the property, what is the best solution for this person, right? Based on the tools that we have in our back pocket and the clubs that we have in our bag. Number two, if you don't have that gift of gab and you're not just a talker yourself and you're transactional like me, and you just want to kind of get straight to the point and it doesn't feel authentic for you to talk about the weather and sports, it's a very natural way to build rapport with the seller because you're doing it by asking them questions. And it's a very structured way to ask questions, low risk questions that are very easy and conversational up front. And then the higher risk questions that are related to equity and the mortgage and defaults and liens on the back end. So it's a natural way for them to feel understood by you because you're asking them good questions that other people have not asked them. How many times have you looked at cash investors, for example? They talk to you just long enough to know how low they can go. They want to know how much equity you have and what your mortgage balance is, just so they know if they can lowball you enough to how much equity you have so they can make an offer for you. But that doesn't build rapport and understanding and a connection with the seller that's meaningful. So it helps you build that rapport naturally. It helps you diagnose the situation to figure out what club works best for them. And the most important thing that it does, by virtue of questions and the type of questions you'll learn, there's implication or consequence questions that if you get really good at mastering how to ask these type of questions, you will agitate the pain that the seller is feeling in a way that's coming out of them. So you can't get a listing and you can't get a contract accepted or them on the deal on paper unless they feel pain and it's front of mind. And so how do you get that pain front of mind? You're going to learn a ninja way that we ask these questions so that you can surface the pain and then agitate the pain to where a lot of sellers don't want to confront their situation. So you talk to a seller who's looking at a foreclosure 3 months away or 4 months away, or they had a NOD or a Liz Pendens recorded recently because the bank started the foreclosure process. They're trying to check out, not confront their situation. Well, the best thing you can do for a seller like that is make it front of mind. So whatever keeps them up at night, you get them out of their routine and in that negative fantasy movie. And now they're willing to take action and sign your contract or sign a listing agreement to get this thing moving. You have to get them motivated. So before you even can go into a prognosis or how you're going to solve their problem, you got to get that ground fertile. And that questionnaire is going to help you do that. So when you go to that website, you're going to be able to download the questionnaire. It's a one-page document front and back. So I like to print it, keep copies in the truck and keep copies at my desk. So I can whip it out every time, not cut corners. I just follow the formula. And then at the end of that 30, 40-minute conversation, if you do it properly, that's how long it'll take. You have somebody who's ready to rock and roll. And you have somebody who's ready for your offer or ready for that listing agreement, whatever solution you want to put in front of them. And you do it in a way that's very natural, and they're talking most of the time and you're listening most of the time, right? So that's where you download the file, and there's a 1-hour video tutorial on how to use that tool properly and get really good at that. I would say the most important part of being an investor and or a really good agent is knowing how to listen and diagnose a seller's problems. And if you don't have a systematic way of doing that, that questionnaire will do that for you. So that's our giveaway this week. With that, guys, if you want to hang out, feel free to hang out longer. We're going to take all the questions and address that with the rest of the group. Otherwise, we'll see you next week, okay? Let's go to Ramy or Frederico. What you got?
Hey, let's hear about LA, Fed.
Yes, sir. Yes, sir, Mr. Corbett. It's been a long time. Happy to see you again. The first question is, I guess, how do we share this recording with someone? Because I think it would be really beneficial with someone I know. Is it going to be posted somewhere?
Yeah, I'm going to put it on, we'll put it on YouTube or our video hosting site, Vimeo, and then we'll text it to everybody who showed up to today's call.
Cool. Okay. Awesome. That was question number one. As far as the creative financing, and I understood you guys said you're gonna kind of dig deeper into that next week. I have a listing that kind of checks all the boxes that you guys were talking about. As far as there's it's a newer construction. The same builder built a new community, a couple miles away. And is offering obviously incentives, better rates, all that stuff. So it's causing us to sit a little longer than anticipated. In addition to that, a lot more inventory has come up in the same community within the last, let's say, 2 weeks. I've been in escrow with this property 3 times. 2 times was with the same buyer who was contingent on the sale of their own home. They fell out of escrow and subsequently fell out of escrow on ours. And then another time it was just some guy who ended up just disappearing after putting his money into escrow and then coming back 4 weeks later and saying he was out. Long story short, we're kind of at the mercy of the builder because my sellers are buying a new house with the same builder in a new community, but we have a contingency that we need to remove, and the builder wants us to remove it or they will cancel on us because they have a lot of demand for their new constructions. So I guess with that being said, my seller owns the property free and clear. There's no loan on it. And he needs the proceeds of this home to close on the property with the builder. I had
Is he
recommended.
buying?
Go ahead.
Sorry, I want to interject.
Yeah,
So I want
of
to
course.
make sure we understand. Is he buying
Right.
the new home cash?
Right. And he needs the cash from the sale of his current home to pay for the new one.
How much is the price of the new home, and how much is he selling his current home?
Selling.
I take it his
go
current
ahead.
home he owns free and clear, right?
Right. Owns free and clear, doesn't owe any debt on it, doesn't have a mortgage. The new home, the current home we're selling for 1.7 million. New home is 1,650.
And is he bankable? If
Yeah, that's
even
my
for a short
question.
amount of time, could he get a loan on the next purchase?
So what I had recommended to him is, hey, why don't we get a loan for a short amount of time? As you said, the challenge is that we bought 2 homes with the builder in this new community. One was for his son-in-law, which he co-signed for. And then after he co-signed for him, my seller, retired. So I'm not sure that he would be a great candidate for a loan since he's retired, doesn't make any money. So I'm not
Does
sure.
he have assets on a balance sheet though? I mean, he obviously had home equity, but does he have other assets?
Not that I'm aware of. I could further look into that.
Is the seller, the builder, they're buying a builder's house, right?
Yeah.
How are builder sales going in that pocket of the market?
The builder has a ton of incentives, so they're clearly kind of beating us. Let's put it that way. To give you an idea, the home that we're buying from the builder at 1,650 was originally priced at 1,785, and we got almost 150 grand in incentives. So, if a buyer comes in, they have us. We're relatively new build. We're 2019, but you could get something that's 2025 build, and you could finish it with your own finishes and get it for less and have a better rate.
Do you have a relationship with the builder?
Yes. At this point, yeah, it's been 8 months.
It would be worth having a conversation with the builder, because if the builder were to extend financing even for a short amount of time with a short-term balloon period for the seller, then the seller could offer financing on their property, and you get both deals done. We're doing that for builders in Austin right now because they can't sell shit. So they spec'd a ton of homes out. We got one builder who has 15 homes he spec'd. He's going to turn them into rentals because he has to go from construction financing to his permanent financing now. And when he did that, he had to swallow a rate that was higher. That is a prepayment penalty if he pays it off early. It's the only thing he could do with the relationship he had with the bank. And now he's owner financing those properties and netting more money every month on passive income than he was renting the property out after all the expenses. And by the way, if you're an agent and your seller ever says that they're going to rent the property out if you can't sell it because you have it currently listed, or you're at a listing presentation and are thinking about renting or selling, anytime you walk through the numbers on owner financing, their payment that's going to be coming in net to them after they get a big chunk down, which you don't do as a rental, you get a big down payment, you net more money every month, and it's truly passive income because you're not dealing with pets, toilets, and taxes and insurance and HOA. That's all on the buyer now, right? So if you think the builder might be open to structuring owner financing or piloting that with 1 or 2 properties, starting with your client, you could solve a problem for both parties by simply starting with that first domino, the first sale contingency or the first purchase, and then coming backwards from there to the other one. And if we get the buyer on a phone call, then we can pitch the benefits of owner financing and why other builders are doing it. Because now they don't have to leave all that equity on the table. They can actually go up in price. Oftentimes you'll see with owner financing, you'll see that on Zillow, buyers are like, how come the price went up? Well, it went up because they just offered these terms, right? And so you're paying a little bit of a premium on the property, but consider you're saving, in the case of, consider this, in the case of a property where you're getting a loan for, let's say $1 million, right? A 2% difference in interest rate is what is that? That's not 200 grand. That's 20 grand, right? Is that right?
I think somewhere along those lines, but it's definitely significant. And I mean, it'll definitely make a difference I don't think anyone wants to overspend if they don't have to.
$1,600 a month difference. So yeah, you pay a little bit more, but you're making that back tenfold because it's like a rate buy down. You pay a premium on the property, but look at how much you're saving every month in interest. As long as you're going to be there for more than 3 years, you made that back. And the builder then doesn't have to leave all this equity on the table. So if a builder, I'm kind of curious what kind of financing he has in place. If he has long-term financing, he's already moved that to, then he'd probably be more open to it than he would if he had a construction loan that had an end date on it. But it'd be interesting to hear from the builder if that might be an option that he'd want to test on 1 or 2 homes to partly play defense in light of what's in front of us. Because he could be a builder offering owner financing in that market.
So to your point, I mean, what would the next, what do you recommend the next step be?
The next step would be if you guys ever have any buddy that wants to talk about owner financing, a seller, and you have a buyer in tow, you can book on my calendar.
Where's that? Is that on the chat?
I just put it in the chat right now.
And then, I just saw it. Let me save that.
Just put in my discount code so you can come in for free and not have to pay. And but you need to have the seller on the call with you. So while you look at my calendar, you book it with the seller. If they have financing on the property, have them bring their mortgage statement with them. And then on that one phone call in 5 minutes, we can structure owner financing. We'll walk them through the steps of getting the deal closed, what the protections are, and what the benefits are of owner financing. And we'll dispel any myths or misconceptions they have about the risk involved, because there are none.
So just to make sure I did not misunderstand, just because I was also saving your information. You recommend that I have a conversation with the seller and see if they're open to just seller financing, and if so, get on a call with you, schedule a call with you.
Yeah, and just say, hey, this is.
Go ahead.
Yeah, sorry to cut you off.
No worries.
If they're open to it, then put them on a call. We'll jump on a web conference. We'll record it for your future reference, and then we'll structure owner financing on 1 or 2 of their properties right there on the call.
Okay, and I guess if they say, hey, well, what's the benefit of the owner financing? I guess the answer could be, we could provide a more favorable rate for a potential buyer, which could also net you more money. Does that sound about right?
They will get 100% more money in total, and command higher prices in similar homes.
And if they, because I kind of have a sense of what the seller will ask you if he says, well, I need all the money up front in order to purchase the next property, this won't work. What's the answer to that? Or how would you kind of answer that question for them?
You're talking about the seller who's trying to sell their property?
Right.
They wouldn't need all their money now. They wouldn't need all that equity in it. They just need the down payment.
Well, assuming you can negotiate with the builder to finance to carry it.
Yeah. Assuming, yeah. So it has to start with the builder first.
That would be your next step, Fed, and that's what I was going to suggest. Go to the builder and feel them out, see if they have any financing products. If not, you could also dangle a carrot for them and say, listen, he needs to move inventory. That builder knows he's catching a falling knife too.
Right.
That's why he's already hammered it down 150 grand.
Mhm.
So you can sweeten the pot by saying you can have a first on the subject property, the new acquisition.
Okay.
But we'll also let you put a first on the seller's current home. So they could have two lien positions for stepping out and offering financing. And then, you could, anyways, you might not have to do that. The other suggestion would be, if you haven't already, get your seller to a non-QM lender, someone who's going to look at his overall balance sheet and, underwrite them as, and also community banks can be helpful in these situations.
Okay.
If they know they have a strong borrower with a strong balance sheet and they're portfolioing that, it's a portfolio loan, they're not selling the paper on the secondary market.
Okay.
You can sometimes find community banks that will want that relationship and will do a loan like that.
Okay. Super helpful. Thank you, guys.
And sorry, Frederico,
Yeah.
I was, to be clear, I thought we were talking about the builder. The whole thing only works if that first domino is willing to do this, which is the builder.
Right.
So that's who we would get on the call.
Oh, we'd get on the call with the builder first.
The builder,
sounds
that
good.
seller,
Okay.
not the other seller. Yeah, my bad.
Perfect. Okay. No worries. Thank you for clarifying.
Absolutely.
Super helpful. Thanks, guys.
Yep.
Good to see
Ramy,
you, Fed.
See ya. Ciao.
Hello.
what you working on?
Not much. I was actually, well, thank you very much, guys. This is a very insightful meeting. Looking forward to it every week. No, actually, the reason I raised my hand because I wanted to follow up on a comment. I can't remember exactly what it is, but it was about the market and that it's some people think it's about to crash. It's about to become another 2008. So I actually have some observation, and since I have a lot of experts here on this call, I'd like to share and get your expert opinion. If my observation, because I don't hear a lot of people talking about this, because I survived 2008 and didn't want to see it again. And for the last 2-3 years, I've been seeing something similar to come. At first, I was very dramatic about it. I was worried that we're going to have another 2008 that is going to come and crash us. But now I don't believe that, because over the time with observation, I think there are two factors that are existing today that did not exist in 2008. The first is quite simple. When I look at the charts, the increase in the rent value around 2008 was a lot less percentage-wise year over year than the increase of rent values in the last 2-3 years, which this takes me to another direction, which is exactly my main observation. The amount of institutional ownership in the market this time did not exist in 2008. So I think after being like terrified for a little bit, because I remembered what happened to me and my family in 2008. So 2021, I started getting panicking, but I have confidence now that if we have a market drop, it's not gonna be near 2008 because of those two reasons. An institutional ownership is huge, and we all know that they can balance their sheets, so they can have 2,000 homes that are losing money and 5,000 that are making money, so they're not gonna just pull the rug. Plus, with the percentage on the increase of the rent, it's still profitable for them, even if, as an institutional like BlackRock, I God only knows how much percentage of the market they own. Unless they decide to pull the rug, then it's over. But so what do you think about this observation? Am I missing something? Do I why not a lot of people talking about this?
Yeah, so it's so to clarify, then you're saying that we're a little bit more resilient today as far as defaults go, because you're
Yes.
saying that you have more institutional investors that own these properties, and the rents are higher now than they were in 2008.
Yes.
For those two reasons, I would say that that's probably a valid point, but consider that 67% of, at least in Florida, right? And if you guys don't know,
Right.
Ramey is on the forefront of doing all the creative finance stuff and everything with his clients and everything, and he's in Central Florida. I would say that in Florida, 67% of all properties are owner occupied, right? So that would leave you 30, the other, what, 1/3 ish, about 1/3 of our market would fall in any type of bucket that you're talking about with institutional clients and people who can weather a storm. I think maybe the counter, so it's a smaller segment of the market. It wouldn't impact the people who have all the consumer debt that are struggling right now that are owner occupied. That's 2/3 of the market, at least in our state, right? The other consideration, something that comes to mind, is that, yeah, first of all, let me clarify. We're not suggesting that we're going to see a 2008 that's going to look anything like it, and the factors are obviously completely different. This is going to be an indirect
I don't mean we are
Yeah.
suggesting this, but actually we as realtors do not explain this because a lot of buyers are scared and a lot of sellers are asking.
Yeah,
But I don't hear a lot of realtors talking to people, like, because some people are still believe that anybody that went through 2008, just like me, they may be thinking 2008 is coming again, but
I hear you.
we don't tell them that it's not, and we don't give them real reasoning. And if we say anything without having reasons, of course they would think, oh, because you're realtors, what else are you gonna say?
Yeah. So that's one thing that comes to mind, is that only accounts for 1/3 of the market, and even when with that third of absentee owner market, what percent of that is institutional investors? It's a minority compared to mom and pop investors. They're still the majority of rental property owners. So now you take even less than half of that 1/3, and that's what those 2 points address as a counter balance to maybe the correction. The other consideration is, like, if you look at how many short-term rental properties are just getting decimated right now, because if it's true that long-term rental property rentals are holding better than they did and compared to 2008, the vacation rentals are doing the opposite compared to then, right? So we had an oversupply of that inventory post COVID, and that between insurance costs going up, property taxes going up, incomes on those properties going down, more regulation on those properties about, hey, these are new rules that restrict how short you can rent these for. You got to do it for 30 days or they get rid of it altogether. So for all those different reasons, I think that at least in the state of Florida, you're going to see, in my personal opinion, I think we're going to see more vacation rentals offsetting what you just talked about, to the negative. And we're already starting to see them dropping their pants on getting their, if short-term rental investors had not had to put 20-25% down to get their loans, we would be seeing a lot more short sales with those properties right now.
Right.
But they're getting their pants handed to them.
Remy, my read on this, like I can see rent compression in many markets, and you look at the number of multifamily doors being delivered. I think it's around 55,000, like new multifamily doors being delivered this year. The developers, they're trying like hell not to lower their rents because it's a cash flow asset. So instead, they're offering rent incentives. So it's, a 2-month free move-in special. So that way it's not actually on, they're not offering lower rent. They're saying this one's rented as $2,000 a month, even though they gave $4,000 in incentives. Relative compared to 2007, I told you earlier, I left a vacation whole ownership market. What we saw is what we're now seeing in the short-term rental, vacation rental in general, like hospitality markets. We're seeing rents actually cut in half in some places. Like the Smoky Mountains is where I moved to, which actually got stronger in 2008. We went from 10 million visitors to 13 million visitors in that recession. What happened the last year? So a good friend of mine, Jay Fratt, who's not on this call today, but he's a broker there, but he owns 4 really 4 high performance cabins in the Gatlinburg market. He was doing $500,000 gross. He's now down to $250,000. So his forward booking cut in half starting last fall is when he could start to measure it. So what I saw in my career, I was really in the leading indicating vertical. It will smash short-term like vacation ownership. Then comes condos. Then we come into single family, and then it kind of ripples through everything. So my read on it is it looks very similar, because especially in those vacation properties, second homes, we're seeing major rent compression. We're seeing major price drops come because people will let that second home go before they let their primary go. And I think it's just a matter of time. Another point, it's a counterpoint just to get you thinking. In 2014, I was working with a small hedge fund out of Sacramento, and they were buying at the auction, and I was using their capital to do deals in Roanoke, Virginia was my market at the time. But I got really close with my friend Aaron, who managed a small fund. BlackRock had just started buying into that market. His brother-in-law was working with BlackRock, so we had kind of some insight into what they were doing. He had a machine at the auctions, and then one day BlackRock pulled out, and I remember talking to him that day. He had 12 flips in progress, actually listed, and his prices fell like 23% in a week. And it was because of the vacuum that BlackRock created when they said, "Oh, Austin, Texas." And they just liquidated the portfolio and moved to Austin, Texas. So that's something else to look out for, is they will eventually cut their losers. You're right. They have a blended portfolio consisting of hundreds of thousands of assets, but eventually they'll do the quarterly accounting and say, which ones are losers. And we're seeing some of that in Florida now. You're seeing some of that on the West Coast, especially, I think. But just some counterpoints to help you argue with yourself like we all are. To me, it looks very similar to the slow set in of 2007 and 8. And rents haven't compressed much, just like prices. We've seen prices move down 2%, and rents have slipped just a little, but in my mind, it ties back to consumer finance. People just we have stagnant wages, screaming high personal debt levels, and people just can't make do anymore. They have, that there's only so much to go around. So the sellers and the landlords have to meet them. So anyways, that's my take on it. I think
I love it. Thank you.
I appreciate your optimism, and I hope you're right.
Well, what's interesting is there are two counterpoints. So I love hearing another counterpoint is banks have a lot more in reserves. Everybody's talking about a credit crisis and banks going under and the FDIC list growing again. Remember when the FDIC bank foreclosure list was just exploding? Banks are a little bit more resilient. Counter argument to that would be, but they're holding on to all this commercial-backed securities, and there's so many defaults with retail and office, and now with multifamily with today's rates, that they're gonna get their butts handed to them in that regard too. I mean, but at the end of the day, when you look at supply and demand, that's why our absorption rate is so important. If you guys don't know how to calculate your absorption rate in your local MLS, maybe that's something we'll cover in another call. We have a template. You can spend 2 minutes on the MLS, pull the total active listings, and then you pull the sales from every week for the last few weeks. I think, Rami, you use this, right? And then you have a thumbnail view of all the factors that play into supply and demand. All the stuff that we're talking about at the end of the day comes down to how much demand is there for the active listings that are out there right now, and how is that trending from a dynamic perspective, right, as opposed to the still picture. And that's more revealing than anything else we can talk about, because all these other factors just play into that ultimate measure, right? And I was looking on ChatGPT. So if 1/3 of all the properties in Florida are absentee owned, then 2/3 are owner occupied. Then what we're talking about here addresses the 1/3, and of that 1/3, 10 to 15% are owned by institutions. 85 to 90% are owned by mom and pop investors or people who have less than 10 properties. So we'll see.
I don't want to see.
Yeah. Hey, either way though, all you can do is, who was it that wrote that book? A.L. Williams wrote the book. All you can do is all you can do, but all you can do is enough. If we're versatile, we have a huge bag of clubs. I mean, it don't matter. Right?
And Ramey, what we're talking about here, I mean, the point of this community is kind of to make you the options trader in the real estate world. So whether it's a put or a call, you can make money on a market correction or an increase. It's just having the right skill set. It doesn't matter if there is blood in the streets. You run in head first and start helping. And a lot of the things we'll discuss, we're helping backstop the market with what we've discussed today, creative financing, short sales. Those are two great ways to actually slow the price drops, to backstop the market and put upward pressure on the comps. So we'll continue the conversation, and even if it is catastrophic, it's probably not going to be anywhere near 2008, but at whatever level it is, we will definitely help you spot the opportunity and connect with those sellers and have the right conversation. But guys, I do have to run. John, I gotta go.
Yeah, we're
thank you
wrapping it
guys
up.
so much.
Thank you
Thanks so much for being here, everybody. We'll see you next week.
See you.
And on that note, Ramey, as it relates to us competing and surviving a turn like that, it's like I told my wife, we're out and walking a trail and a bear comes. To survive, she only has to run faster than me, right? You don't have to have all the answers. You just got to be able to beat the competition and be more resilient.
Right. Especially we had the same run before, so we know what it takes.
Yeah, and the purge is already happening with licensees. I think we had a net loss nationally of about 200,000 licensees in the last couple of years, and that number is trending upward. So the space is clearing, and if you saw what happened on the back of the last financial crisis, it actually got more fun to work in the business because the people that were left over on the other side of the closing table knew what they were doing. And so I'm starting to feel a little bit of that happening right now as it is.
Unless you were a mortgage officer like I was back then.
Oh, yeah. Probably hurt, right? So anyway, Ramey, I appreciate the input. Thanks a lot, Alfredo, for your input, for your time. Enrico, for your input. The more we contribute, guys, the more valuable it's going to be for everybody. So thanks a lot for joining us. Spread the word. MMMweekly.com. Mastermindweekly.com is where our counterparts can join this call. Spread the word, and we'll see you guys next week. Okay. And then I'll text everybody the link to watch this over again if you want to reference it in the future. Thanks for joining us.
Thanks
we'll
so
see
much.
you next week.
All right.